Welcome, everyone. Planning for retirement can often feel like a real tug of war. On one hand, you want your money to grow, right? But on the other, you also want to protect it at all costs. So today, we're going to look at a financial tool that's designed to solve that exact problem by offering something many retirees crave most: predictability.
It's a fear that keeps so many people up at night. You've spent decades saving, and just the thought of a market downturn completely unraveling your plans, it's terrifying, especially when you're starting to actually rely on that money. This is really the central challenge we're tackling today.
Because you see, planning for retirement isn't just about saving. It's this constant balancing act between the need for your money to grow and the absolute non-negotiable necessity of protecting what you've already built.
Now, there's a risk here that is uniquely dangerous in retirement. See, when you're putting money into an account, you can just ride out the market dips. But when you start taking money out, a decline forces you to sell more of your assets at a lower price. And that can do permanent damage to how long your money's going to last. But then there's this other, more subtle risk that a lot of people just overlook: policy behavior risk. What's that? It's the chance that the financial product you bought doesn't act the way you thought it would years down the line. It's basically about the rules of the game changing on you right in the middle of it. And that hidden risk, well, it brings us to a really specific issue you can find inside many annuities, what we'll call the moving target problem. Okay, so a standard fixed indexed annuity, or an FIA, links your potential earnings to a market index, but the key thing is how you actually earn that interest. The rules, things like caps, which limit your maximum gain, or participation rates, which define how much of the index's gain you actually get, well, those can often be reset by the insurance company every single year. And here's the problem with that. You might buy an annuity based on these really attractive terms they offer you in year one, but by year 5, the company could just lower those renewal rates, and that directly impacts your growth potential. It effectively changes the product you thought you owned. This quote just nails it. The stress of wondering whether the terms on your core retirement asset are going to change every year, that's a big deal. It forces you to constantly reevaluate your plan, which is the exact opposite of the peace of mind you were probably looking for in the first place. So if the problem is a moving target, the solution is pretty simple, right? You need to lock it down. And that's what this next approach is all about: creating a much clearer, more certain path forward. So enter the guaranteed rate FIA. This is a specific type of fixed indexed annuity that's built to solve that moving target problem. Instead of those annual resets, it offers crediting terms, the rules of the game, that are guaranteed for a specific, stated period of time. The process here is actually incredibly straightforward. First, you fund the annuity. Then, and this is the key part, the crediting terms are contractually locked in for a set period. And the result? Your path forward becomes way more predictable. No more annual surprises. Okay, let's be absolutely crystal clear about one thing. When we say guaranteed, we are not talking about a guaranteed interest rate like you'd get with a CD. No, we're talking about a guarantee on the rules. Your interest is still tied to an index, but the formula they use to calculate your earnings, that's the part that's locked in. All right, so this all sounds pretty interesting, but how do you know if it's the right fit for your specific situation? Let's break down the kind of person who this really clicks with. So, who is this for? Well, it typically resonates with folks between, say, 55 and 70, who are just laser focused on protecting their principal. If you're a conservative saver, you're tired of the market roller coaster, and you just want to know the rules won't change on you, this is designed for you. It's for anyone who values predictability way more than chasing the highest possible returns. Look, in any financial decision, there are always trade-offs. So let's look at the central trade-off here, that balance between potential gains and contractual guarantees. It really all boils down to a fundamental choice. With a guaranteed rate FIA, you are buying a very high degree of predictability. In exchange for that, your maximum potential upside might be a little more modest. With a standard renewal FIA, you might have a higher ceiling for growth, but you're trading that for a lot less certainty. And this is the bottom line for so many retirees. If you're putting a portion of your portfolio into an annuity, you're probably doing it for stability and peace of mind. For that kind of person, predictability isn't just some nice feature. It's the entire reason for using the product in the first place. Okay, let's wrap this up with the practical details, because understanding the fine print is absolutely essential before you make any decision. The number one question we always hear is about liquidity. It sounds great, but can I actually get to my money if I need it? It's a fair question.
Here's what you really need to know. First off, annuities are designed for long-term money. That said, most contracts will let you withdraw up to 10% of your account value each year without a penalty, usually after the first year. If you take out more than that during the surrender period, charges will apply. And it's worth noting, a lot of contracts also include waivers for major health events, like needing to go into a nursing home.
So, what's the most important takeaway here? Always, always ask for the official product illustration. This is the document that cuts through all the marketing and shows you exactly what is guaranteed, for how long, and it discloses every single fee and charge. Never, ever make a decision without reviewing this document carefully.
And that brings us to the final question, the one I want to leave you with. As you're mapping out your financial future, what do you value more? Is it chasing the maximum possible potential, or is it building a foundation on solid, dependable predictability? The answer to that will tell you a whole lot about the right path forward for you.